The European Union is in a critical phase of negotiations with the United States as the deadline looms for a potential re-implementation of tariffs by President Donald Trump. With only 2 days left before the July 9 deadline, the EU is scrambling to secure a trade deal to avoid Trump's threatened 50% tariffs on its imports into the U.S. The situation has already caused significant disruption in global markets, with businesses pausing investments and the dollar experiencing its worst performance in 5 decades during the first half of the year. The talks, which include up to 18 agreements with key partners, have so far resulted in only 2 finalized deals, with the UK and Vietnam. The EU faces internal divisions on how to proceed, with German Chancellor advocating for a swift UK-style agreement to prevent a trade war, while French President Emmanuel Macron prefers to hold out for more favorable terms. Brussels Trade Commissioner Maroš Šefčovič recently faced threats of 17% tariffs on food imports during discussions with senior U.S. officials. The EU's strategy now appears to be shifting towards securing a framework agreement, similar to the UK's, as the possibility of a comprehensive trade deal seems increasingly unlikely. This shift underscores the challenges the EU faces in leveraging its economic clout, with €1.6 trillion in transatlantic trade at stake, to negotiate better terms, as industries across Europe brace for increased costs from a minimum 10% tariff on exports to the U.S. The economic impact of Trump's trade policies continues to loom large over the global economy.
Emerging market and local bonds have experienced their strongest first half in 16 years, driven by a significant decline in confidence in the U.S. dollar. This decline, marked by an almost 11% drop this year, is the greenback's worst performance since the 1970s. As a result, an index of local debt has returned over 12% in the first half of the year, significantly outperforming hard currency bonds, which posted a 5.4% gain. This trend reflects a broader shift among money managers seeking alternatives to U.S. assets, with debt funds attracting more than $21 billion in inflows so far this year. The appeal of local bonds is further bolstered by the prospect of interest rate cuts in developing countries, enhancing their attractiveness, particularly for European investors amid a weaker dollar against the euro. Notably, Latin American economies like Mexico and Brazil have provided substantial returns, with local bonds generating gains of 22% and over 29%, respectively. This rally is supported by improving economic fundamentals in some regions and easing geopolitical tensions, making local debt from the developing world an enticing option for investors. Despite the recent rally, many investors, including Aberdeen's Edwin Gutierrez, remain committed to their positions, anticipating a prolonged rethinking of exposure to U.S. assets.
Foreign direct investment (FDI) into the United States has reached a significant milestone, with the country attracting $311 billion in 2023, solidifying its position as the leading global recipient. This represents a 13% growth from the previous year, a notable achievement considering the declines observed in most other regions. The European Union emerged as the largest contributor, accounting for $140 billion, or 45% of the total FDI. Key investments include Volkswagen's $800 million initiative to electrify its Tennessee assembly plant. Other major contributors to U.S. FDI include Japan, Canada, and the United Kingdom, each investing over $35 billion. A crucial component of this investment surge is the growth in greenfield projects, which involve new operations rather than mergers or acquisitions. A standout example is Taiwan's Semiconductor Manufacturing Company's TSMC $65 billion investment in a new chip plant in Arizona, reflecting the strategic importance of the semiconductor industry amid global supply chain challenges. The sustained high level of FDI into the U.S. underscores the country's attractiveness as a stable and lucrative market for foreign investors, which could have positive implications for job creation and economic growth domestically. This trend also highlights a shift in global investment patterns, with China experiencing a decline in FDI, as visualized by Citi's data.
The latest data from the New York Federal Reserve Bank highlights a significant increase in U.S. household debt, now totaling $18.20 trillion as of March 2025, marking a $4 trillion rise since the pre-pandemic period in 2019. Despite this daunting figure, the burden of debt repayment relative to disposable income has decreased, with the St. Louis Fed reporting that household debt service payments constituted 11.28% of disposable income at the end of 2024, down from 11.72% in 2019 and significantly lower than the 15.85% recorded during the 2007 housing bubble peak. This suggests that while overall debt levels have risen, the capacity of households to manage their debt has improved, indicating a level of financial prudence among American consumers. In contrast, federal financial management appears less sustainable. The Peter G. Peterson Foundation projects that federal interest payments will consume 18.4% of federal revenues by the end of 2025, escalating to 22.2% by 2035. With federal debt poised to exceed $50 trillion within a decade, largely due to legislative measures like the Big Beautiful Bill Act, the federal government's fiscal strategy remains heavily reliant on future economic growth to mitigate the burgeoning deficit. This juxtaposition of consumer versus federal financial responsibility underscores the broader economic challenge of balancing growth with sustainable fiscal policies, raising concerns about the long-term implications of rising national debt on economic stability.
In June 2025, foreign portfolio investors, FPIs, injected 14,590 crore rupees into India's equity markets, marking the third consecutive month of positive net inflows. This trend was supported by improved global liquidity, reduced geopolitical tensions, and a rate cut by the Reserve Bank of India (RBI). However, this optimism was short-lived, as FPIs became net sellers in early July, withdrawing 1,421 crore rupees, indicating a shift in sentiment possibly influenced by upcoming tariff deadlines and volatile U.S. economic data. The future of FPI flows is expected to remain volatile, with analysts emphasizing the importance of Q1 FY26 corporate earnings results in shaping market sentiment. In terms of sectoral investments, FPIs showed interest in financials, auto components, and oil and gas sectors, while withdrawing from capital goods and power sectors, indicating strategic repositioning based on performance expectations. Despite the positive equity inflows, FPIs pulled out significant amounts from the debt market in June, with 6,121 crore rupees withdrawn from the debt general limit and 6,366 crore rupees from the debt voluntary retention route. This cautious approach in the debt market reflects concerns over elevated U.S. bond yields and ongoing trade tensions. The investment climate in June was also bolstered by a strengthened rupee and stabilized oil prices, suggesting potential renewed interest if favorable economic conditions persist.
Amazon has decided to discontinue a free service for its customers, marking a strategic shift amid a period of robust financial performance. The company reported a 9% increase in net sales year-over-year for the first quarter of 2025, reaching a net income of approximately $17 billion, nearly 40% higher than the same period last year. This decision comes as Amazon continues to adapt to changing consumer behaviors, possibly reallocating resources from free services to areas with higher growth potential or profitability. The move to end the free service could have various implications. For Amazon, it may streamline operations and improve margins, especially if the service was underutilized or costly. For consumers, this could mean a shift in how they interact with Amazon's ecosystem, possibly encouraging them to explore other paid services or alternatives. This decision reflects the broader trend of tech giants reassessing their service offerings to align with evolving market dynamics and financial objectives. As Amazon navigates these changes, its strategic adjustments will be closely watched by investors and competitors alike, given the company's significant influence in the retail and technology sectors.
The recent surge in the stock market, often described as a melt-up, is primarily driven by investor speculation about significant interest rate cuts anticipated in 2026. This optimism is largely influenced by Morgan Stanley's forecast of up to 7 rate cuts during that year, which investors believe will enhance equity valuations and market performance. Despite the Federal Reserve led by Chair Jerome Powell, not committing to immediate rate reductions, especially given recent strong employment data. Investors are already pricing in these future cuts, reflecting confidence in a more favorable monetary policy environment. However, not all experts share this optimism. Liz Ann Saunders, a strategist at Charles Schwab, cautions that the current market strength is partly due to stable interest rates. She argues that multiple rate cuts could signal weaker economic conditions, particularly in the labor market, and warns against over-reliance on speculative forecasts. Saunders emphasizes the importance of focusing on company fundamentals amid these predictions. As investors anticipate potential changes in Federal Reserve leadership and policy direction in 2026, they are advised to remain vigilant and consider broader economic indicators and geopolitical factors, such as tariffs, that could impact future rate decisions and market dynamics. This situation highlights the disconnect between market expectations and current economic conditions, underscoring the need for a balanced approach to investment strategies.
Chinese mining companies are significantly ramping up their international acquisitions, with 2025 set to be the most active year for overseas deals in over a decade. This surge is driven by a strategic push to secure essential raw materials critical to global supply chains. The Financial Times reports that this trend marks a pivotal shift in the commodities mergers and acquisitions (M&A) landscape, highlighting the increasing importance of resource security for China's economic strategy. Key players in this development include major Chinese mining firms and a variety of global mining and metals ETFs, such as VanEck Rare Earth and Strategic Metals ETF, REMX, and iShares MSCI Global Metals and Mining Producers ETF, PIC. The move is likely to impact the stock prices of these ETFs and related mining companies, including Sibanye-Stillwater Limited, SBSW, Southern Copper Corporation, SCCO, and Rio Tinto, Rio. This strategic acquisition spree underscores China's commitment to maintaining a stable supply of rare earths and strategic metals, which are vital for various industries, including technology and manufacturing. The increased Chinese investment in overseas mining ventures is expected to influence market dynamics, potentially driving up valuations of targeted mining companies while also affecting global commodity prices. This trend may lead to heightened competition among international mining firms and could prompt regulatory scrutiny in some jurisdictions concerned about foreign control over critical resources. For investors, this development suggests potential opportunities in the mining sector, particularly in companies that are likely acquisition targets or those involved in rare earth and strategic metals.
West Pharmaceutical Services, Inc. is facing a federal securities class action lawsuit as Faruqi & Faruqi, LLP investigates potential claims of misleading investors. The law firm is calling on investors who suffered losses exceeding $100,000 between February 16, 2023 and February 12, 2025 to explore their legal options. The allegations focus on West's purportedly false or misleading statements about its business operations, particularly concerning its high-value products portfolio and the SmartDose device. These products, marketed as high-margin growth opportunities, reportedly encountered significant destocking and operational inefficiencies. The issue escalated when West announced a weak revenue and earnings forecast for 2025 on February 13, 2025, attributing part of the downturn to the loss of major continuous glucose monitoring contracts. This announcement resulted in a 38% drop in West's stock price, closing at $199.11. Furthermore, the SmartDose devices were identified as negatively impacting profit margins, leading the company to consider potential restructuring efforts. This situation underscores the risks associated with operational missteps and the importance of transparency in corporate communications, as these factors can significantly affect investor confidence and stock performance. The outcome of the class action could have substantial implications for West's financial recovery and investor relations.
Rocket Pharmaceuticals is facing a legal investigation by the law firm Faruqi & Faruqi, LLP, following a significant decline in its stock price due to a clinical hold imposed by the FDA on its RPA 501 Phase 2 study. This investigation is centered around allegations that Rocket Pharmaceuticals misled investors regarding the safety and clinical trial protocols of its gene therapy candidate, RPA 501. Specifically, the company is accused of failing to disclose a critical amendment to the trial protocol, which involved the introduction of a new immunomodulatory agent. This amendment allegedly led to a serious adverse event, say, resulting in a participant's death and prompting the FDA to halt the study. As a result, Rocket's stock price fell by approximately 37%, from $6.27 to $2.33 per share, reflecting investor concerns over the company's transparency and management practices. The law firm is investigating claims on behalf of investors who suffered losses exceeding $50,000 between February 27, 2025 and May 26, 2025, and is considering filing a securities class action lawsuit against Rocket Pharmaceuticals. The deadline for investors to seek the role of lead plaintiff in this potential lawsuit is August 11, 2025. This legal action could have significant implications for Rocket's financial standing, investor confidence, and future operations, emphasizing the critical importance of transparency and accurate information in clinical trials.